G'day there, ladies and gents. Mark Wallace here from Econisis, and thank you so much for joining me here today for a brand new video. My first video of 2024. Apologies for the lack of videos in the last couple of months. To say that Econisis has been busy would be a gross understatement. We are absolutely flat out, having the privilege and pleasure of working across the country. Some big projects, including here in Queensland with the Gold Coast, as well as in northern New South Wales with Tweed, with transport for New South Wales, as well as a lot of work over in Western Australia on a really diverse range of regional and metro projects. So as a result of that, we've had a couple of new people join the business. Mira has joined in a part-time admin role, which is amazing, taking a huge amount of burden off the team as the team grows, and also adding Lachlan Parenti, who just joined us as well as another student economist in the consultancy. So thank you so much to both of them for joining me and joining us here in the team in Econisis. But today, we're going to talk about the fact that we've had some data come out from the ABS, and that doesn't paint a very big picture, or very good picture, when it comes to the current state of the Australian economy and what that means, I guess, going forward over the next sort of 12 to 18 months in the economy. So we did have the data come out on the GDP growth for Australia for the December quarter and showed a 0.2% growth for the quarter, which is the slowest quarter there's been since September 2021, when we had obviously the significant declines associated with COVID. The fall and the slowing follows a revised 0.3% September quarter in 2023, and has basically been 5 quarters consecutively of slowing growth, albeit remaining positive, which is good, but really only on a technical sense that we're not in recession. The reality is that parts of the economy absolutely are in recession. The economy, the non-boomer household economy, has basically been in recession for almost 2 years now. And so when you look at spending patterns out of households, particularly non-boomer households or households that are linked to sort of wages rather than interest rate increases for driving their incomes, you can see that that's part of the economy has absolutely been in recession for almost 2 years now. Never really fully recovered from COVID as inflation took over. Wage rises are the first in many cases, for many households, the first ever, and really the first of any sort of note in about 15 to 18 years, fully engulfed by inflation, mostly in the beginning with imported inflation, and then driven by some capacity constraints in the economy during the post-COVID recovery period. The boomer households, on the other hand, are living the dream, living the best time of their lives, really, as they both have the highest drawdown on welfare, but also somehow the highest level of house price appreciation and income growth from fixed incomes as interest rates increase. Boomer households actually make money and spend more money rather than help with the slowing down or the preventing of the overheating of the economy, and we very much have seen that over the last couple of years. The federal government has been very intentionally not inflating or adding to the inflationary pressures of the economy. But certainly one of the most constrained and probably most fiscally capable governments we've seen in quite a while, without trying to get overly political. Certainly have taken a very astute position when it comes to the economy, doing enough to keep things afloat, doing enough to build genuine long-term capacity, even changes to the statutory rate cuts being more on a broader base, generally not having any real inflationary effect because it's the same money into the economy, and with only some minor spending patterns. The reality is that it's a really been generally a relatively benign contributor to inflation, and if anything is really one of the only factors that is sort of keeping the economy fully out of recession at the moment. Also helps that they're actually running a budget surplus, which is something we saw obviously the previous government and governments before that really struggled to do, really ever since the GFC, and major tax cuts have then undermined the revenue base of the country and forced more and more of the revenue to be reliant upon households, which obviously are in the moment very much, for the most part, struggling in the current economy. Imports have reduced, which has helped, and exports increased, which also helped. So that helped to add significant contributions to last quarter's economic activity. And then obviously we also saw, but we did see businesses reduce their stockpiles and reduce their inventories, and that shaved some economic activity off the economy as well. So basically it's a bit of a mixed bag. If it wasn't for exports and the government, we'd probably well and truly be in recession at the moment. And it's hard not to blame all this on the RBA. The reality is that we've known for some time that the RBA overcooked their rate increases. That they went too hard for too long and too high. That their understanding of the intergenerational responses to interest rates, and therefore the hiding of what effectively has now been a multi-year household sector recession in this country behind the largesse and excesses of baby boomer consumption. It just really was never recognized, and now they're wondering why they're seeing such a significant and in some cases precipitous fall in household expenditure, as the realities are starting to bite even for some of the boomer households. So look, that's obviously having a big impact, and we're probably, I'd say, about 75% basis points in the rate rise, in rates above where we probably should have been based on the inflationary pressures, and as a result of that, inflation is falling much faster than where the RBA's and governments and treasuries consensus position was for a return to the top end of the inflationary, the target band of the RBA of 2 to 3%. Sometime in 2025. We're going to get there by June. We're already at 3.2% annual rate. We're going to be well to the bottom, in my opinion, of the target band into the next year, and potentially even fall below the target band. And if that does happen, then you're going to have to see interest rates starting to cut. So we've had three increases. And the last three increases will be reversed really quickly. Of course, there won't be an acknowledgement of the horrendous and damaging mistake that the RBA made that inflicted so much pain and damage on so much of the population from that decision. I think the reality of the new, now well entrenched, but still new RBA governor, continuing the line of the RBA as an organisation with the inflationary hawk, but a headline focused only approach to monetary policy. Unfortunately, I don't see see them admitting their mistakes and their folly as we move into this new cycle. Now, we can't obviously just blame the RBA as much as that is gloriously enjoyable to do so. There obviously are significant headwinds on a global basis. The exception being the US, which is actually doing incredibly well, has come off the back end of their inflationary pressures, are growing the fastest they've grown in years. And obviously, it's hard to look past the Biden government's achievements on the CHIPS Act as well as the Inflation Reduction Act and its central role in driving a lot of that activity. It's hard to look past the media, which seems to, particularly on the right side, paint the US as an absolute diabolical disaster area of apocalyptic proportions. But the reality is it's actually doing really, really well. And I think the biggest risk now is obviously a change of presidency, which will revert us back to some of those bad policies that resulted in the economic deterioration. And unfortunately, that's the reality of a distorted US political system. But in the short term, I definitely see the US continue to be a positive contributor to global growth. China is unwinding at a massive rate. They have fully decoupled their rhetoric from reality, talking about 5% growth in 2024. They'll be lucky to stay out of a full recession for the entire year. It's a full unwinding. The level of discontent and economic inactivity in the population now is just flying in the face of the views of 5 to 7% growth year on year, which really the Chinese Communist Party has had to historically maintain in order to maintain its political sustainability. And unfortunately, that seems to be unwinding for them and for the people in China. That obviously has huge impacts back to Australia in terms of our resources. Now, probably not as big impact as it has had in the past, in part because the wolf warrior diplomacy and all of the associated tariffs have already helped the Australian industries decouple from what was their previous almost universal China dependence in the last 3 to 5 years. And so we may look back at that wolf warrior diplomacy and the incentives it created for Australia to diversify our trade base as an absolute boon for us and for the economy and a huge buffer to us, particularly as we've become more and more integrated into the US domestic economy through the Inflation Reduction Act and the supply chains there. So those China headwinds are absolutely going to have some impact and add to the slowing of the growth, but they are secondary factors. The big factor was the RBA just overshot, and despite all the warnings and despite all the commentary coming back that they did the wrong thing, the reality is now dawning that they did the wrong thing, and we'll see. I suspect we're going to see in the first half of this year probably 2 rate cuts, and then I suspect we might see another 2 in the second half of the year. And that'll be in response to what is going to be now 12 to 18 months of either recessions and or slow growth, and it's going to be a pretty soft landing in some respects, because for a lot of the economy they're already been in recessions for such a long period of time thanks to the RBA that they we're not going to see that their recession deepening. It's just other parts of the economy are going to join. The real boon we have, or the real benefit we have, is we do have a fiscally capable government with budget surpluses who have the capacity to take an approach to the economy which is much more aggressive, expansionary, and supportive going forward into the future. We're also absolutely going to see the impacts of accelerated expenditure around infrastructure and growth in that space as we see the major infrastructure projects nationally really come to the fore, and we're also going to see things like the Brisbane 2032 Olympics starting to have some contributing effects as over the next sort of year to 2 years some of those projects start to commence as they go forward. So those things will definitely help, but we're expecting 12 to 18 months of slowing growth. Now, that will mean, however, that we would likely potentially still see some significant house price increases and growth in the next little while as we see the interest rates being forced to come down, and just the latent demand that's being priced out of the market starts to come back into the market as the excessive interest rate environment starts to be unwound. And so that's likely to support prices in some markets and drive growth in other markets, particularly highly attractive coastal and or master plan community markets, areas where there's strong jobs growth, areas where there's strong sort of school opportunities, really in for that sort of second, third, fourth home buyer, mature households sector. And so those areas are probably going to experience some decent growth, at least for this calendar year, though that could slow if the economy continues to slow further. But I'm certainly not expecting to see, with the latent demand in housing, this to all flow through to that of house price declines. We are definitely going to obviously see a decrease in the historical migration trends. Look, it was a migration pattern that I think was in part reflection of the return of a lot of the international students and temporary residents to the economy post-COVID that sort of blew up that 500,000 plus number more than it probably actually was. But it did have an impact on things. We also obviously are dealing with a once in a lifetime decrease in our construction workforce as that ages, and so that big migration push to get more workers into the economy as the population generally ages, particularly in the construction and healthcare sectors, was definitely necessary, but came at a time when the impacts of both of those things on the housing market in terms of vacancy rates, now at historical lows in terms nationally, are having an impact on the were in place, and so it definitely exacerbated that in the short term. So look, a lot of flux happening in the economy, slowing in the economy. It's going to be uneven, it's going to be bumpy. We may slip into a recession, we may be able to keep ourselves out of it. I suspect we're going to see a much more vigorous government in the lead up to the next election as well, with a lot more project announcements, a lot more new projects on the books. I think you're going to see a number of funding programs increase to sort of address some of these gaps, but definitely within the background of a slowing in the economy thanks to the aggressiveness and now, in retrospect, over exuberance of the Reserve Bank when it comes to monetary policy. But that's where we're going to leave it today. Thank you so much for joining me for the first video in 2024. Hopefully you have enjoyed this one. If you have, make sure you subscribe, hit the like button, leave a comment if you found this interesting, and also follow me on my social media accounts over there at LinkedIn, both my personal account as well as for Econisis, where we post these videos as well. But that is it for today. Thank you, everybody. Have a great one. See you next time.